Welcome, guys, to our channel Banking Sutra. Today, in this lecture, we will be covering next section in financial derivative series 1, which is options. And in this lecture, we'll be discussing options in details with their real-time examples and specifically different types of options and what are the basic terminologies used in options. So let's start today's lecture. First of all, we will be discussing the definition of option. What is the textbook definition of option? So that the thing will be clearer. Options may be defined as a contract between two parties whereby one party obtains the right but not the obligation to buy or sell a particular asset at a specified price on or before a specified date. As you can see, there's an option seller, there is one option buyer, two parties, and the contract happens in presence of maybe OTC, over the counter, or stock exchanges. So the thing is that this is the significant difference between among future and forward and options. In future, contract happens between two entities in presence of exchanges. In forward, it happens over the counter, OTC, and but in case of options, there may be both. Means either or. There may be OTC transaction or with exchange. So here the person who acquires the right is known as the option buyer or option holder. The second person who confers the right is known as option seller or option writer. So now we will be breaking down the options definition and discuss it in detail so that it will be clearer to you. In options, as the name suggests, it gives one party option to take or make delivery. And the important part is that in options, only one party get the option to take or make delivery. Yes, but this option is given to only one party in the transaction, while the other party has an obligation to take or make delivery. Means, for example, option buyer who purchases the option, who buys the option, has the right to exercise the option or not, and the second party who's the option seller, he has the obligation to sell the underlying asset compulsorily. Okay, obligation means he has to sell. But the thing is, why the other party will entertain you in this transaction? Okay, so the reason is that the option buyer has to make a payment. The option buyer has to make a payment which is known as premium to the option seller. Due to this reason, this option seller will entertain you and make this transaction. So some of the quick facts we'll be discussing about options. In April 1973, the options on stakes were first traded in an organized exchange, which was Chicago Board Options Exchange. And now the current state is that options are now traded on various exchanges in various countries all over the world. Even options, as I told you, options are now traded both on organized exchanges and over the counter, but initially it was started on organized exchanges. Recently, option contracts on OTC are getting popular because they are more liquid. And if you have seen my previous lecture, I have told you forward is OTC, okay, and OTC derivatives are more liquid because they are customized and they are cash settled, okay. So these are more liquid in comparison to future, which are happens in presence of exchanges. Now comes the example so that the things will be a lot more clear to you. For example, there is two parties are there, option seller and option buyer. And for example, Mr. X, who is the option buyer, wants to purchase a house, okay, and the cost of the house was too much, and he is not able to afford this house. So what happens? They negotiated a deal, okay, and deal suggests that the option buyer who sees the house can buy the house in 3 months at rupees 2 lakh. Okay, this is the deal happened between option seller and option buyer. But the thing is, why the option seller will sell this house to option buyer at rupees 2 lakh and in 3 months also? Because it may happen that in 3 months the cost of the house will increase too much. So why is selling? So the thing is, he has to receive some premium for that. Okay, and he set the condition that you have to pay a price of rupees 10,000 for this negotiated deal. So what happens now comes the thing that option buyer accepted this deal, and he is willing to pay option premium. Now the condition is that there may be a two possible hypothecated conditions will happen. First, the house has historical importance, and due to that, market value of the price rise from maybe it was initially 5 lakh to 10 lakh. Okay, and remember the negotiated deal was rupees 2 lakh. Okay, but as the option sellers sells the option and option buyer buys the option at rupees 2 lakh, the option seller is obligated to sell this house at rupees 2 lakh in 3 months. Okay, so what is the benefit of option buyer? It is a clear benefit. In the end, this person, which is option buyer, will make a profit of rupees 7,90,000. How? Because the price was price is initially is now rise to 10 lakh rupees, and the strike price, which is the negotiated which is the price which is negotiated between these two, also known as a strike price, was 2 lakh, which was to be which is to be paid to option seller by option buyer, and rupees 10,000 is the premium which option buyer has to pay to the option seller. So these two payments only has to make for purchasing the house, means only 2 lakh 10,000 has to make. And if you subtract 10 lakh and 2 lakh 10,000, you will get 7 lakh 90,000, and this is the actual profit based on current market condition. So option buyer gets a profit of rupees 7 lakh 90,000 for this deal. Now, suppose what happens after this is the second condition. After inspecting the house, the option buyer came to know that the house condition is not good, and it is not that house which he dreamed of. So now the condition comes, what will happen? Okay, so in case of option, because he buys an option, he is not obligated to purchase the house. So as you can see, in case of options, the option buyer has win-win condition in both the parts. Okay, in the first part, as you can see, he has purchases the house, and due to the rise of market price of the house, he earned the profit. And in this case, as the house condition is not good, and maybe the reason is that is due to within 3 months he came to know that area is not good, and price of house is getting lower in the future. So he's decided to not purchase the house, because he purchases an option, and option has the right to for the option buyer that he is not obligated to purchase the house. So, but the thing is, this is of course he will have to face a loss of rupees 10,000, which was the option premium which he has to pay to the option seller, and that option premium is non-refundable. Remember this thing. option premium. Once the deal settled, once the option buyer purchases the option, then he has to pay the option premium and it is non-refundable, which is, I think, not a big deal because uh, instead of purchasing that house and investing 2 lakh rupees in that house, which is not a good one, it's better to lose 10,000. Okay. So this is again a win-win condition for option buyer. So now, what things these example demonstrate to you? Two important points. First, when you buy an option, you have the right but not an obligation to do something. You can always let the expiration date go by, at which point the option becomes worthless. So here I will give you a highlight to you that what is this means actually. The second part of the example, when the person who purchases the option decided not to go with the purchase, so he simply let the expiration date, which is of 3 months, let go. Okay, so after the expiration date over, then this option become worthless and it is automatically got cancelled. Okay, so the two things are important in option transaction. First is uh, uh, the option price and the option time at which you will have to purchase that underlying asset. So if that time overs, then your transaction, the option contract, will be cancelled. Second, an option is merely a contract that deals with an underlying asset. And for this reason, options are called derivatives because options derives its values from something else. And here, in this example, it derives its value from underlying asset, which was house. Okay. Now comes to the some of the core important features of options, and some of them are already discussed, but I'm giving you just a summary. Option contract gives the holder right to do something. The holder may exercise his option or may not. He has the option for that. The holder, which is here, holder is the buyer of the option. Okay, the holder can make a reassessment of the situation and seek either the execution of the contracts or its non-execution be profitable to him. Means he has the full right to reassess his situation within the options time, that he will go with the option, go with the purchase or not. This is a very important part. And he is not under obligation to exercise the option. So this fact that he is not obligated to do a transaction or exercise the option is distinguishes options from both forward contract and future contract, because in the both of the cases I told you in my previous lecture that in forward and future both the parties have to complete the transaction, are obligated to buy or sell the underlying asset. Recently in India, what happens, the banks, all the banks, commercial banks, are allowed to write cross currency options, and this permission is given by Reserve Bank of India. So as you can see, options are getting more and more popular in different countries, especially in India also, because of their ease of use, and they are quite liquid. Now come some of the basic types of options, and I think you know that what are the two basic options types. First is call option. In call options, what happens? The holder has the right but not the obligation to buy an asset by a certain date for a certain price. As I told you in the example of house purchase, that was a call option example, because that the option buyer has purchases the option but has not obligated to buy the asset. Second type is put option. In put option, the holder of the option has the full right to not the obligate to sell an asset. It is just an opposite, to sell an asset by a certain date for a certain price. And I have not told you any example for that. So I'm giving you a real-time example so that put option will be clear to you. Suppose the current price of TCS share is rupees 950 per share, and there is a Mr. X who owns 1000 shares of TCS private limited company, and he apprehends that in future the prices will decline, thinking that from 950 it will go to 900 or 800 due to current market conditions. So he has a greater risk of a big loss. So for that, option put contract is available at BSE, and at the strike price of that is rupees 1000. Okay, in the next 2 month delivery. Here the two things are very important. First, the price, which is the strike price, and this is the spot price, the current price, and this is the strike price. So it is now greater than rupees 50. And what is the benefit of that? That is, if he purchase in the next 2 month, okay, in the next 2 month, if he purchases or exercises the option, he will get the share at rupees 1000, which is higher than the current rupees 950. Okay, and the premium cost for that, the cost which option buyer has to pay to the option seller, which is BSC here, is rupees 10 per share. Okay. So Mr. X will buy a put option at rupees 10 per share at a strike price of rupees 1000. So in this way, Mr. X has hedged his risk of price fall. Okay. It may happen that the price of the stock, this share will severely gone down from rupees 950 to 900, 800. So in this way, he has avoided the risk and save his money. And Mr. X will exercise the put option if the price of a stock goes down below rupees 990. Okay, and will not exercise the option if the price is more than rupees 1000. This is the important thing, that Mr. X here input option, there is what is the option available to the option buyer. If the price of the stock goes down below rupees 990, what he was thinking was that the price will be in the lower side from 950. Okay, and he purchases the price and he purchases the put option at rupees 1000. So what happened if in future, after achieving the price, for example 1000, TCS share price increases to rupees more than 1000, again it goes down from 1000 to below 990, then Mr. X will exercise the put option, because it may happen that it will further degrades, and will not exercise the option if the price is more than rupees 1000 on the exercise date. So the person, the Mr. X, has the options to exercise the option or not. So now comes different types, other types of options. The two basic types I told you, call option and put option. So in other option types, there is American option. American options are generally those options that can be exercised at any time up to the expiration date. Means whatever the option I have told you earlier, call or put, that was generally American option, because in both the cases the option bearer has the right, means as the option to to purchase the house within the 3 months time, and in the second example, the put option holder has the option to sell the shares, exercise the option if the price of the shares gone down from 1000 to 990. And most exchange traded options are American. Now comes European options. European options are those options that can be exercised only on the expiration date itself. And due to this reason, European options are preferred, because these are easier to balance and handle, because there is a specific time, and based on that time the options are exercised. Now comes the in the money options. In the money options, what happen? These are basically positive cash flow to the holder if it were exercised immediately. Means if immediately the person, the holder of the option exercised, then these type of options are known as in the money if it uh, becomes positive cash flow to the option bearer. And the condition for this is spot price is greater than strike price. In out of the money options, what happen? It leads to negative cash flow if it were exercised immediately. And the condition for this is that spot price is smaller than strike price. And the last one is at the money options. In at the money options, uh, it leads to zero cash flow. And the condition for this is that spot price is equal to strike price. So now comes the some of the terminologies of options so that it will be not be a confusion to you. If any term related to options comes to you in your examination or in your studies. So first one is option class. All the calls and puts option on a given underlying security or index represents an option class. For example, all calls and puts on, for example, XYZ stocks are on one class of options, while all calls and puts on another ZYX index are another class. Okay. The thing to be noticed here, the first one are stocks, the second ones are index. Based on that, they are classified into different classes. Next, the option series. In option series, all the options of a given type, whether they are calls or puts, with the same strike price and expiration date are classified as option series. Now comes the option price. Option price are generally option premium. Strike price, as I told you, it is the exercise price. This is the stated price in the agreement, in the contract, at which the bearer of a call has the right to purchase a specific future contract, or at which the bearer of a put has the right to sell a specific future contract. And the spot price, as I told you, it is the current market price of the underlying asset for which the options transaction happen and from which the option derives its value. So this is the options lecture, and I hope that it will clear your doubts regarding options derivative. And if it happens that if any terminology or if any concept you don't understand, please write to me in comment section so that I can clarify you. And stay in touch with my channel. I will be uploading more lectures on banking and finance related topics and specifically core banking topics in the coming weeks. Thanks for watching our lecture.